Alright, welcome guys to another YouTube video. This is going to be an educational YouTube video series where I talk about certain topics in trading that are basically sparsely and separate concepts that one can put together and add to their trading knowledge. It's not going to particularly consist of a trading model, but it is valuable knowledge that you can use to your advantage when you're doing technical analysis. Now, starting off, first off, the topic of this video is Wicks, right? And you can see in the thumbnail that Wicks are order blocks. You might be wondering what that means. Well, first of all, we need to understand what candles are, right? So a candle, two types of candlesticks. We have bearish candlesticks and we have bullish candlesticks. Now, candlesticks come in lots and lots of shapes and sizes. And if you don't know what a candlestick is, if you're completely new to trading, which I doubt, you should not be watching this video. You should be watching some more beginner stuff. Even though this is beginner level, you should understand what a candlestick is. Now, if you understand what a candlestick is, you will know that a candlestick has two things. Every candlestick has four things. Every single candlestick has four things. Now, every single candlestick has an open. Let me get my text tool so you can see it. Every single candlestick has an open, a close, a high, and a low. Now I'm going to make this a bit bigger. I'll put it on 20. Put it on bold. I'm going to make it black. Every candle has these four things. Every single candle. Now, when I say wicks or order blocks, wicks have to do with everything inside of this, right? Wicks are made from the open to the low of the candle and from the close to the high of the candle, or in this case, from the high of the candle to the close. Now, we all know that a graph, candles are made from movement on a graph. And a graph has two axes. This is time and this is price. Time and price. If you don't know how that word or phrase came about, that's essentially how it came about. Time, the X and the Y axis, time and price. When price moves, well, you can either view it in a line format or you can view it on a time-based interval format, which is essentially what candlesticks are. Candlesticks let you get your books. Candlesticks allow you to view price on a time interval based format. What does that mean? Every candlestick has an interval, right? On TradingView, if you look to the top corner right here, you can see we have certain intervals. The 90-minute interval, the 1-hour interval, the 4-hour interval, daily, weekly, 30-minute. There's millions of them. You can have custom ones. There's so many. You can have anything you want. Trading candlesticks is based off of intervals, and that's very important because to understand the concept that trading wicks, to understand the concept that wicks are order blocks, you need to understand the simple fact that trading is not just, it doesn't move in just, when you look at candlesticks. This is all part of understanding what candlesticks are and how to use them. Now, when price opens for a bullish candle, price most likely for a very bullish candle, price more often than not will put in the low of that candle before it puts in the high and then closes. So usually price will put in the low of the candle in the first opening, first quarter of the candle or whatever. We don't want to go into that. We just want to focus on, the anatomy of the candle, and then, it usually makes the bulk of the move of that candle in the middle point of the candle. And then it closes in the final, quarter or third of the candle. And that essentially is how you have a candlestick. Now, when you have candlesticks, you have wicks. When there are no wicks, well, that means it's an engulfing, which is why I said if you don't really understand candlesticks, this video is not about candlesticks. I will try to make a video about candlesticks. But when you have wicks, essentially what wicks are opposing candles. The wick of a bullish candle is made up of bearish candles. Take your notes out again. the wicks of a bullish candle, the wicks of any bullish candle is usually made up of bearish candle. That wick exists because of bearish candles. Now, obviously, candles are made up of more candles in the lower time frame, and it gets kind of confusing if you're not really used to it. But the wick of a bullish candle will be made up of an opposing candle. Likewise, the wick of a bearish candle would be made up of a bullish candle on the lower time frame. When price opens to go up, and you have this move right here, right? This first part of the bearish candle move, it has to be made up of bullish candles, right? And then it switches to bearish candles, changes delivery state, and then it continues to go lower. So based off of that idea, that is where you have the concept that says wicks are order blocks, because an order block is the last opposing candle in a series of candles. Now, if you have up close candles, like I said, bullish, 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 and then you start to have bearish candles, well, first of all, you have an order block. That last bullish candle at the top is an order block. Now, I just said a lot of things. An order block is a last opposing candle in a set of candles. Now, when you say in a set of candles, you're referring to the most recent set of candles. When you have up close candles, which is a bullish uptrend, that is, it's up close candles. Now, when you start to have bearish candles, which is down close candles, a new trend is starting. And when you close below the last set, the last up close candle, that's a change in state of delivery. If you don't know what a change in state of delivery is, you can join my channel. I talk more about this stuff, and you can just research it. What is a change in state of delivery? I'm sure you find something on YouTube. You don't have to pay someone to, teach you what a change in state of delivery is. Now, when you have a change in the state of delivery, essentially price has created an order block. Now, there's two types of changes in state of delivery. The first type is when the first close just after that last candle. The last candle that prints the last up close candle right here, which is this one right here. That once we close below that candle, once we close below the open of that candle, in this case, it's a bullish scenario turning bearish. So once we close below the open of that candle, that is a change in the state of delivery, and we expect price to start to deliver lower. Usually, it's based on context and lots of other factors. Then you can assume risk, but on the basis of it, we just expect price to start moving lower. Now, I'm going to clear all of this out because I just said a lot. Now, again, a lot of this won't make sense to you if you don't actually put in the time to study. This won't automatically make you profitable, and you're going to have to do more than just listen to me talk. You're going to have to go into the markets and try to practice what you're listening to here. Now, like I said, wicks are made up of opposing candles. So for those candles to be opposing, it means that at some point when this candle closed and whatever happened after it, an order block was formed at that wick. So when you have large wicks on candles, that means there is an order block. Now, what are order blocks? We've talked about candles and we've talked about how candles form. What are order blocks? Well, order blocks simply are when you have price change the state of delivery. An order block is that price run that created the swing point in the change in the state of delivery. So in this price run, this is like a classic reversal head and shoulder kind of pattern. Trading is all about patterns. Don't let anyone tell you that patterns are useless. Patterns are good. You need to be able to recognize patterns as a trader because it will help you as a trader in a lot of ways that I can't really talk about here. But an order block is made up of a change in the state of delivery. An order block only exists after a change in the state of delivery has formed. And a change in the state of delivery is a close below the last set of opposing candles. Again, when you say the last set, you are referring to the most recent set of opposing candles. And in this case, the most recent set of opposing candles are these bearish candles here. Before that, we had bullish candles. And when we close below the open of the very, very first bullish candle, it becomes a change in state of delivery. I'm going to go into a real chart example that happened this week, just this week, and we will talk about that. Now, when you have that change in delivery, an order block is formed. And when that order block is formed, usually price refers to that level and goes back to that level, refers to that level, and then trades into it and then trades out of it. And most times you can find a setup, again, based on pattern recognition mostly. I trade ICT, and a lot of ICT concepts that I trade are, based on these foundational concepts. Now, when you have an order block, usually price will return to this order block and then trade out of it. Now, you can take a setup, right? You can take a setup. Let me use the risk to reward tool instead of, drawing. So if I take my short tool right here, where is it? Short position. After we have the change in set of delivery, you can set your order at the order block open and at the high. Again, there's a lot more. There's a lot of ways order blocks can be used. This is just a basic video. Now, this essentially is, in a perfect world, this is what you would have as a bearish setup. A perfect world where nothing was wrong. Obviously, there's time factors and lots of other factors that, one would have to employ to make this profitable. Unless you would just be a regular pattern trader who is unprofitable, which is why, if it was this easy and all you have to do is just to find this and then trade it, everyone would be millionaires. But it's not this easy. You have to employ different, strategies and be very good at pattern recognition, to be honest. So I'm going to take all of this off. Again, if you need to hear anything I said, you might have to rewind the video. Now, for the last part of this, when you have order blocks or you have wicks, usually on the higher time frame, on the lower time frame, those were order blocks that were formed, and price usually refers to them and then trades out of them. And if you will notice, price created another order block here. And this is just something I just drew, but because I've looked at it so much and I've seen it so many times, I can just draw something and it looks like something that the market will actually do, right? So it seems random, but it's not random. And the moment you start to realize that it is absolutely not random, that is when and only when you'll be able to make a single dollar from these markets. People who try to say that the market is completely random, I have a theory that they're either lying to you so you don't become profitable, or they just don't give a shit and they just say whatever. But truly, they do what they do behind the scenes where you don't see it, and they trade those exact same things that they tell you to stay away from because it's random. It's basically gambling. So it's not random, and these things do happen, and everything is with probability. Also with human factors, you could have a lesser degree of accuracy, but for the most part, it is not random, and it does repeat a whole lot of times. So it's all up to you to learn. Now, we're done talking about patterns and whatnot. We're going to go into the real chart and see how this plots. Now, you can see I just have these two charts. These are completely clean charts. I hid the candles. I'm going to come here and I'm going to turn the candles on so you can see what is going on. Now, on this chart, we have the gold chart on the 4-hour chart. This is the gold futures contract, GC. As a trader, I trade a combination of concepts. And as much as I trade ICT, I pride myself on being a very avid pattern, someone who's able to recognize patterns. And that is really important because in this scenario, after we traded lower, we had this right here. This is the weekly open. This is when the week opened. So let's focus on this week's price action. Today is Friday, the 27th of June. And you can see we had this open right here. And what do we have here? Well, that right there is a wick. I'm going to turn my magnet on so we can. That right there is a wick. Well, what other obnoxious wicks do we have? There's lots of wicks, right? There's lots and lots of wicks. How do you know which one to focus on? That's another thing. You have to look at context. In this context, well, we can say that we were bearish from this order block and price has been moving lower. And we just took this range high. What's the most likely target? Well, that target would be this low. And a lot of times, even myself as a trader who has been doing this for quite a while, I still get lost and I still lose. And, like in this case where I tried to short, I was a bit early to the short and I got stopped out. And I got stopped out in some longs when I tried to long. That's when the short actually started happening. I'm going to get to that in a second. But essentially, wicks are order blocks, right? So we have this wick, we have this wick, we have, what else do we have? We have this wick, right? These are all wicks. Sometimes price gets to them, sometimes price doesn't get to them, but it's important to know that they exist. So when you're doing multi-time frame analysis, you can know the key levels to watch out for. Now, this is just a touch of the iceberg, and like I said, there's lots more to look at, and I picked gold because I knew that this would be a good case study for what I wanted to talk about. Now, we have this low. This low was liquidated by this high, and I was, kind of bullish because I was expecting the low to be purged and go higher, but we failed to do that. As you can see, price was repeatedly going down lower and making these wicks. So I tried to short on this, and I was a bit late. I was a bit early to the short, got stopped out. And I share all of this. I share all of this on my Telegram channel, my wins, my losses, my entries. So if that's something that interests you, you can join down below. It's going to be linked in the description. Now, we're going to focus on these two wicks, and we're going to talk about how price reacted on them. When I said wicks or order blocks, you're going to see just what I mean by that. And I'm going to highlight these wicks. And when we go down to the lower time frame, you're going to see how price reacted to them. So first off, this is the 4-hour chart. Personally, it's a personal preference. I like to go to the 15-minute chart and look at what the chart looks like from the 4-hour. Something called time frame alignment. I've talked about this on my Twitter and threads and stuff like that. I don't want to confuse you. If you haven't heard about time frame alignment before, don't worry. It's not, you don't have to feel like, oh, there's something you need to learn urgently. But yeah, so I'm going to go to the 15-minute time frame. And right off the bat, you can see right here, remember, this is the weekly open, right? So this is when the week opened. We traded higher into this wick. You can see, even on the 15-minute chart, it's still a wick. You're not seeing any bodies in this wick. That means it was a very violent move, and it happened in a very short period of time, because if this size of a move, which is from 3413 to 3400, 13 points. 13 points on gold is a very large number. It's about 130 pips. If something that big of a swing happened in just 15 minutes, because remember what I said about candlesticks are a way of viewing price in a time-based interval, status, or, what's the word? I don't even know the word. Anyway, this is a very large wick, and you can see price reached into it. So since we can't see the bodies, I'm going to go even lower to the 5-minute, one step lower, to see if we can find any bodies inside of that order block. So even on the 5-minute, there are still no bodies. This large of a move happened in just 5 minutes. Again, the week just opened, and usually lots of explosive moves happen at the weekly open. So if you go even lower into the 1-minute chart, you can clearly see on the 1-minute chart, and I know because I looked at this obviously before I started the video, you can see this last up close candle. And that candle is what formed the order block. And that single candle on the 1-minute chart is what caused this move right here on the 5-minute chart. And if you were to trade this, well, I won't just short this wick. I'll wait for price to reach into the wick and then form a new order block, because to trade reversals, you want to trade with order blocks. And when price changes the delivery state, well, I'm going to short that change in the state of delivery and target, near sell side, whatever. There's lots of lows that you could have targeted this low, and that's basically it. Well, you might be wondering, well, if I'm talking about this, why didn't I take it? Well, I had shit to do on Monday, and I didn't trade Monday. I didn't trade a lot this week, so lots of these setups that I'm showing you, I did not take them. But rest assured, you don't need to believe that I can trade it, whatever. All you need to know is what I'm teaching you, what I'm telling you right now. We had this order block we traded into it formed another order block and traded out of it. So you can see how this wick acted as an order block. I want to stay on topic here so the video is not too long. Secondly, going back to the 4-hour chart, we have this wick. Now, I trade quarterly theory, and there's something about this wick I'm not going to talk about. I'm going to post it on my Telegram channel after I make this video. There's something about this candle at 10 p.m. on Monday, 23rd of June. I'm going to post it on my Telegram channel, so make sure to keep an eye out for that. I'm also going to post it on my Twitter, so that's another thing. So we had this wick, and you can see price traded into that wick and traded out of it. Well, on the 15-minute chart, let's see what that wick looks like. Right off the bat, you can just see right here, this is where the 4-hour candle opened, right? And you can see, what is this? The exact same thing. This is an order block. These up close candles right there, that is an order block. And you can see price very, very, very quickly displaced from that level. And it didn't come back to that level. This was on Monday. When did it come back to that level? All the way on Thursday. And when it got there, what did it do? Well, again, it was very violent and it went lower. So you can see that these levels are important to have on your chart. And I did have this level on my chart. I'm going to try to put it in post recording. I did have this level on my chart when I was posting my analysis on my channel. And you can see we came right into it, formed another order block. So you can see reversals are primed on order blocks. When you trade reversals, you want to be focused on order blocks. You want to learn how to recognize order blocks and how to trade order blocks. Now, in this case, you could have easily taken the trade with this fair value gap. If you notice, this happened in the London session, and it's another trade that I did not take. Even though I traded on Thursday, I did not take this because it happened when I was asleep. And yeah, I tried to short, I think, here in the AM session of New York. I can't remember where it was. I think it was here. So I tried to short and then I got stopped by something. It's just complicated, but essentially I wasn't able to make any money from gold this week because it was really tough price action, to be honest. But if you traded the London session, there were still some good setups. Even this, I could have set a limit for this. If I wanted to trade this as a limit order, I would have left it open for days, and eventually I would have gotten triggered. Well, you might ask, well, how do you do that? Well, we already know that the 4-hour candle opened, right here, right? And this is the order block. These up close candles. Well, it's really simple. If you're trading the order block, your stop loss is going to be at the opposite end of that order block that you're trading. Trading your bearish order block, the opposite end is the high of that order block. Now, when it comes to large wicks like this, personally, I try to avoid keeping my stop loss below the midpoint of the wick. So most likely my stop would be at this wick's high, or I'm not a beginner trader and I have ways of setting my stop. But what you need to know, for the most part, if you're trading the order block, your stop, your entire entry zone is the order block. So your entry would be this entire thing, and that would be your entry. So you can see that is the high of the order block, and you could target this low. I also posted on my Telegram that I was trying to take a sell run into this level, and you can see that if I had set a limit, which I did not, I would have made this trade. So a lot of times it's actually about pattern recognition. You need to know how to recognize patterns. So now that you've been armed with this information, I'm not going to go on and show you every single wick that's in the market. It's up to you now to go to the market, find examples like this and backtest, and know it for yourself. Of course, I will be available for questions on my Telegram channel, Twitter, wherever it is you can contact me. I have links in the description. I will be answering your questions, and no, you don't have to pay me. So that's it. I'll see you in the next video.